Kitco News special coverage of the New Orleans Investment Conference is brought to you by Discovery Group.
Hello, I'm Michelle Makori. Welcome back to our coverage of the New Orleans Investment Conference. My next guest was one of the few that correctly called the 2008 financial crisis. And he's been warning for a while now that we are going to have a crisis far worse than that one, that the dollar's days are numbered, and that it is time to pay the inflation Pied Piper. I'm thrilled to welcome back to Kitco News none other than Peter Schiff. Peter is, of course, the founder of Schiff Gold. He is the founder and chief market strategist of Euro-Pacific Asset Management and the author of 3 New York Times best-selling books. Peter, great to have you back with us.
Well, Michelle, it's nice to be with you in person.
We actually have not done this in person yet, only remotely. So good to have you here in person and good to hear your presentation last night.
I'm glad that you were able to hear it.
Yeah, it was bad news as always, Peter, but backed by some very valid points. So let's go through that. And of course, you're so well known for being one of the few to correctly call the 2008 financial crisis. People were ridiculing you, but you were cautioning that the subprime mortgage crisis was going to happen, and you were one of the few to actually correctly call it and even time it. And during your presentation last night, you were saying that things in the macro environment are starting to feel quite similar to how they did back in 2007, including the trend of some economic revisions, some economic data being revised. So break that down for us. How are things feeling like 2007?
Well, in 2007, a lot of things happened in the mortgage market, particularly in subprime, that I had been predicting would happen for years. And I had been predicting that that would be the trigger of a much broader financial crisis. And so in 2007, I saw the evidence that my forecast was correct. And I became more emboldened in my predictions of this crisis. But the mainstream was very dismissive of what I was saying. Even up till the summer of 2008, we were right around the corner from this global financial crisis. And we were in the middle of what became known as the Great Recession, the worst recession since the Depression. But even up till the summer of 2008, people were denying that a recession was anywhere in sight, let alone that we were in one. And why it reminds me now, this is the fourth quarter of 2023, why it reminds me of the fourth quarter of 2007 is because a lot of the forecasts that I have been making since pretty much the beginning of QE and 0% interest rates was that eventually rates would move up and it would be a huge problem for everybody who had loaned money, the banks, and then the U.S. government, of course, would be in a lot of trouble because it borrowed so much money and now had to deal with rising rates. So a lot of the predictions that I've been making are coming true, yet once again, the mainstream is oblivious to these risks, just like they were oblivious in 2007. And I also think it's significant because in the fourth quarter of 2007, that's when the Great Recession began. But during the fourth quarter of 2007, we were reporting rosy economic numbers, just like we are reporting now. It wasn't until the fourth quarter of 2008, a year later, that they went back and they revised down an entire year's worth of economic data. Right. And all of a sudden, those rosy statistics became the Great Recession. And I have a feeling that a year from now, we're going to find out that the economy wasn't nearly as good, in particular the labor markets, as we were being told. And I think that Joe Biden's horrific approval ratings, he's the lowest or the least popular president since Jimmy Carter at this point in his first term. There's a reason for his lack of popularity, and it's because the economy is lousy. The numbers are not capturing how bad things are.
All right, well, we'll get into Joe Biden in a little bit because I think there are other reasons, not just that, but I get the broader point, and that you're saying that things feel worse to consumers than the data would reflect, and that's why Biden's popularity is down. But to your point about revised economic data, that we've had another Peter on the show, Peter St. Onge, who's actually made a similar comment that the data is being revised downwards, but people aren't going back to look at it, that the numbers come out and people say, oh, great, GDP, 4.9%.
Yeah.
And they react on that. But then they don't go back and look when the data gets revised. And just as an example of that, we had the Bureau of Economic Analysis revise down the last 3 years of economic data, revised down. In 2022, just one example, GDP contracted at a 2% rate in the first quarter, and that was revised down from the previously reported 1.6% growth. That's quite a revision. Consumer spending is now estimated to have been flat instead of what was reported, which was a 1.3% rate of growth. So these revisions are already coming through.
And first of all, a lot of the numbers are just guesses anyway, and they're very subjective and they're very biased in what they want to report. But look, we got the jobs report that came out today for October. Lots of revisions, all downward to prior months. But the numbers we got today were horrible in that only 99,000 private sector jobs were created. 51,000 government jobs were created. I mean, we don't want those government jobs. I mean, they're not productive, and they run up the deficit because we have to pay for them, and the government doesn't have the money. We lost 35,000 manufacturing jobs. Those are the jobs we want. Those are the ones that we lost. Those are productive, higher-paying jobs. But also, the unemployment rate went up. The labor force participation rate went down. And in fact, if you look at the household survey, I think 400,000 people lost their jobs. And the 99,000 jobs that were created by the private sector, that was well below estimates, they were all part-time jobs, and they went to people who already had a job, or two, or three. The number of Americans holding down multiple jobs just hit another all-time record high. People don't want two or three jobs. They want one job. But the problem is one job won't cut it anymore because food is so expensive. Rent is so high. Insurance, medical care, taxes, everything is going up except people's paychecks. I mean, maybe they're going up a little bit, but they're not going up enough. And that's why they now need 2 or 3 paychecks to do the job of one.
Right. A very valid point. And in fact, I believe it was you who once told me in an interview that we did back in my Bloomberg days that getting the government to give you CPI data is like asking the mafia to give you the crime statistics.
Correct.
I believe that was one of your lines.
And I haven't been on Bloomberg in like 15 years, so you must have been pretty young back then.
Yeah, fresh off the plane to New York. So, I mean, even the data that they're giving us in the first place needs to be taken with a giant grain of salt. And now they're revising that data as well. But it was interesting, though, you mentioned this bad jobs report, and equity markets rallied on that because that signals that the Fed is most likely going to pause. And we're having the situation where we have bad economic news equals good news for the markets in terms of a rally because it means that the Fed is likely to pause or even cut rates. But at what point, Peter, does this bad economic data and the fact that we have high inflation and lower unemployment and all of these conditions that happen when you've had interest rates go up from like practically 0 to 5.25% to 5.5% over the period of 18 months. At what point does the bad economic data start to be reflected in the markets?
Well, I mean, it's going to be reflected in the markets, but I think the traders have got it wrong. They believe that a weakening economy means a weaker inflation, that if we have more people unemployed or not as strong an economy, that we're going to have a reduction in inflation. And they've got that wrong. And that's because they have this Keynesian belief that inflation is a byproduct of economic growth, that a strong economy creates inflation. And that's not true. Actually, a strong economy helps counteract the inflation that the government creates. The government, the Federal Reserve, and deficit spending is the source of the inflation. Now, sometimes the inflation can be masked by a strong economy, which is productive and turning out more goods and services for that money to buy. But like the jobs numbers that we just got are highly inflationary. The markets don't get that because we lost productive jobs. We gained non-productive jobs paid for by the government, which means bigger deficits. As the economy falls into an official recession, the deficits that are already horrific, that are over $2 trillion a year, are going to probably double to $4 trillion or more. And that is inflationary because the Fed is going to be printing money to monetize all that debt. The weaker economy is actually going to send inflation higher. And in fact, the main reason that inflation came down as measured by the CPI from 9% to about 3%, and now it's already trending back up. It wasn't because of the rate hikes. It was because the rate hikes caused the dollar to go up. And it was the strong dollar that brought down oil prices, other commodity prices, and helped bring the CPI down. But I think the dollar has topped, and I think it's about to surrender all of those gains. And in fact, if you look at what happened this past week, it was a significant, I think, reversal, outside reversal, where the dollar index took out the high from the previous week, yet closed significantly below the low from that prior week. And I think the dollar is about to drop. And so if the dollar has put in a top, that means inflation has put in a bottom. And that's going to be a very difficult predicament for the Fed, because just as the economy is weakening, inflation is going to be strengthening. What do they do?
Well, what do they do? Because that seems to be the big question. And you've actually said that the dollar's days are numbered. Now, granted, you've been saying this for a while, but it seems as though you're really doubling down on the case that we're going to get an even worse crisis than we did in 2008, and that we could be on the brink of a sovereign debt crisis.
Well, we're going to have a sovereign debt crisis, a currency crisis. The Fed has to pick which one. Ultimately, we'll probably end up having both. But initially, they're going to have to choose between causing a financial crisis that's worse than '08 with no bailouts, right? So that means real serious losses. It's not just that a bank fails, and all the big banks that we bailed out in 2008 will fail, and they're much bigger now, and it'll be a much more disastrous collapse. But it means that depositors at these institutions will lose money, because there is no money in the FDIC to make these, insolvent banks whole for the depositors. So the Fed is either going to have to allow a massive, financial collapse, or in order to prevent that, it's going to sacrifice the dollar, and it's going to surrender in its inflation war, and it's going to allow much, much higher inflation. They're going to have to stop pretending that the goal is 2%. I mean, we're going to be much, much higher. We'll be in the double digits.
So what is the trigger, or what is the point where you see the Fed forced to acknowledge that it's surrendering, as you put it?
Well, whether it's ever going to officially wave that flag, or the markets are going to have to figure it out just based on what the Fed is doing rather than what it's saying. But you're looking at the foreign exchange market, watch what happens to the dollar. If I'm right, if we really start to break down on the dollar, if gold takes off, gold's been hanging out around 2,000. It hasn't been able to really break above it. I think when we decisively move above 2,000, maybe 2,100, we hit a record high. Gold will probably never trade below 2,000 again, and we'll have a solid base of support. And when the gold price really starts to get closer to 3,000 and 2,000, which you can do very quickly, that's really, a warning sign to the world that, we're out of room here, that there is a crisis of confidence in the Fed, in the dollar, in the Treasury market. And we start to see the long end of the curve really starting to get hit. 30-year Treasuries are now back below 5%. They're like 4.85 or something. But the curve is now normalizing somewhat, because the yield on the 30-year didn't go down nearly as much today as on the 10-year or as the 5-year. But when we really start to see the yields blowing out because rates are going a lot higher, that's when it's going to hit the fan, because now the economy is going to start reacting to this big backup in rates. The commodity prices are going to start reacting. Oil prices are going to react to the weak dollar. All that's going to obviously start showing up in CPI. So you're going to start to see these inflation numbers moving up as the economy is weakening. We're going to start to see a big uptick in unemployment. And, the Fed is going to have to choose. And I think publicly, especially, it's an election year next year. And if unemployment is rising and the economy is weakening, the Fed is going to go for stimulus. Well, stimulus is inflation. That's all stimulus ever was. Mm-hmm. That's the only arrow in their quiver, is inflation. That's what quantitative easing is. It's inflation. It's a euphemism for inflation. And they're going to go back to that. They're going to abandon quantitative tightening. They're going to go back to quantitative easing, even as inflation is well north of 2% and rising. And then the markets will figure this out, and then, the currency will collapse, and inflation is really going to break out. And then the Fed is going to have to decide, is it going to do anything to rein that in, or just allow, hyperinflation?
Okay, so one point that I want to focus on that you made there is you're ready to call a bottom of gold at 2,000?
I think it's putting in a bottom here. I think the dollar is put in a top. I think that if you can buy gold below 2,000, I think you're getting a great price because, once it puts a little bit of distance between itself and 2,000. So let's say 2,100. I don't think you'll ever see it below 2,000 again. I think it's just like, you can't buy gold for $100.
Like 1,990. I mean, we've seen it like...
No, right now, we need to get above 2,100, let's say. We need to decisively break out of this range so that the resistance is gone. And then I think a lot of money is going to move into gold. I mean, right now people are thinking, well, why buy gold? It can't get through 2,000. I mean, there's not a lot of upside. So the buyers are waiting for a break. They want to buy 1,850 or 1,900. So they're patient, they're waiting. But I think once we really break out, they're not going to wait. They're going to stop waiting and start buying.
So Peter, how do we get, though, from high inflation and the Fed, as you quite rightly said, election year, inflation is unpopular, they may cut rates, they may print more money, they create more inflation, but how do we get from higher inflation to currency collapse? Why is there no in between where we just deal with a very unpleasant situation of high inflation, but don't go so far to such a dramatic point of dollar currency collapse?
Well, because we use our dollars to pay for all the goods that we don't produce. And so the world needs to want our dollars. And not just our dollars, they have to want our debt. They have to want our treasuries. Because when all these countries that are running trade surpluses with the United States, they earn all these dollars, what do they do with them? They buy treasuries. So they have to want to own our debt. They have to want those treasuries. They have to want those dollars. But they only want dollars if they're confident in the future purchasing power of those dollars. They have to believe that the Fed is serious about maintaining the purchasing power of the dollar and keeping inflation low. But once our creditors recognize that inflation is out of control and that the Fed is no longer, trying to rein it in, it's more concerned about propping up the economy, propping up the government so it can keep on spending, then our trading partners are not going to want those dollars anymore. And we have a real problem because now the value, the exchange rate is going to collapse. And then we can't afford to import all of those goods that we were previously importing. Well, how is our economy going to function without those goods? Because we don't have a domestic source of those goods. And we've built this entire service sector economy on the foundation of imports. Because if you don't have the products, then most of the services don't have much value either. So you take away the products and everything that's been built on top just implodes. So our entire GDP just collapses. Meanwhile, we owe the world a fortune. We're the world's biggest debtor nation. We have more debt than all the other nations combined as far as what we owe. And how are we going to service that debt? It becomes more and more expensive, a bigger drain on the economy. I mean, look at just the interest on the national debt. I mean, at the end of this year, interest on the debt is going to be a larger expense than defense.
Yeah.
About trillion.
$860 billion.
But by the end of next year, it could be the biggest. It could be more than Medicare or Social Security. Over the next 3 years, half the debt matures. So that's 34 trillion. Half of that is 17 trillion. We have to go out and borrow that 17 trillion to repay the maturing bondholders because they may not want to roll those bonds over. We've got to borrow that money. Over the next 3 years, I'm sure at a minimum, we're going to add another 10 trillion to the national debt, at a minimum, probably more. So that means we have to borrow $27 trillion. At what rate of interest? And what is that going to cost? Because even if we have to pay 5% interest on that money, that alone, just that 27 trillion is close to 2 billion or 1.75 trillion rather in annual interest, annual. And that doesn't even count the interest that we're paying on the other debt. So if we're paying $2 trillion a year in interest on the debt, that's about 50% or 45% of our current tax revenue. But in a recession, our tax revenue is going to go down. So maybe interest on the debt will be more than half our tax revenue. And if this continues for a couple more years, interest on the debt will consume 100% of our tax revenue. And everything the government wants to spend money on, 100% will have to be borrowed, which is impossible. There's no way we can make it without a complete collapse, which is why it's going to happen.
And certainly servicing the debt has become a major talking point for many people. Jeff Gundlach, the CEO of Double Line, he was saying the other day that he thinks that servicing the debt could be the cause of the next great financial crisis.
Because he listens to my podcast.
Oh, maybe. That may be so. But then, Peter, we have those that would counter that and say, fine, sure, that the US dollar is going to continue to be debased and continue to be devalued. But what is the alternative for those wanting to not own dollars? That it's all relative, and it's still, as they say, the cleanest shirt in the dirty laundry basket.
Well, that's what
people
making that argument for a long time. I think it's a lot dirtier than people think.
It may be a lot dirtier, but it's still relative, right?
No,
it's still why is it not? Why is it not a question of relative to what? Like, what would replace the dollar? What would be the asset they'd be buying instead?
I think it's been a self-fulfilling prophecy. The dollar's been strong because of the perception that it's strong. So whenever there's a problem in the world, people just reflexively buy the dollar. And that's helped us. I mean, in the long run, it's going to come back to bite us, but it's enabled us to continue to go deeper into debt and keep this whole thing going and kick the can down the road. But perceptions can change very quickly. Mm-hmm. And people that want dollars can all of a sudden not want them anymore. And that's going to be a big problem. And it's not just the interest on the debt, which people are focusing on. It's the principal, because the maturities are short. And that means when the bonds mature, we have to pay back the principal. And if people don't want to lend the money again, they just want their money back because they want to do something else with it. Now the Fed is under tremendous pressure to buy, because if the Fed doesn't buy, then rates have to soar in order to convince somebody who doesn't want treasuries to hold them. So if they don't want to hold them for 5%, well, maybe 10%, maybe 15%. What's the point? But the problem is, if we have to pay 10%, we can't afford it. It's just the numbers don't work. So in answer to your question about the alternative, the best alternative is gold. I mean, gold is the alternative to the dollar. Right?
So you're going to see countries opt to buy gold instead of the dollar, that will be the alternative.
Right.
I mean, we're already seeing the trend with central banks.
Well, remember, before the dollar came on the scene, gold was the reserve behind every currency, including the dollar. Every currency was backed by gold. The dollar was actually legally defined as a weight of gold. That's what a dollar was. It was a quantity of gold or silver, because in America, the Constitution put us on a bimetallic standard. So a dollar could be a weight of gold, or it was a weight of silver, but that's what it was. And when Bretton Woods came around, all of the countries agreed that instead of holding gold directly, they would just hold dollars. And we had all the gold because the dollar was redeemable in gold. Right. And so that standard, that dollar standard, was a gold standard. And when they said the dollar was as good as gold, it was because we promised to pay gold to anybody who had dollars. Now, we defaulted on that promise in 1971. And so then we told the world, you're holding dollars, but you're no longer holding gold. You just got the dollar. And the world accepted that. And we've been on that system, for over 50 years, where currencies are backed by dollars and dollars are backed by nothing.
Right.
Now, I think that what's going to happen is, as countries start rejecting the dollar, they're just going to go back to gold. People think that the dollar can't lose its place because there's no other currency to take its place. And I would agree that the euro shouldn't be the reserve currency. The yen, the Chinese RMB, the pound, none of these currencies should be the reserve currency, but then neither should the dollar. So there are no fiat currencies that should be anybody's reserve. Every fiat currency should be backed by real money. And the best real money on the planet is gold. And that's where the world is heading. Now, politicians don't want this, but this is where we're going, because the people need this. The people need real money. And it's the only way to rein in the excesses. And at the end of a currency crisis, if you want to restore order, if you want to restore confidence, how are you going to do it? You're going to have to go back to gold.
Right. Need for sound money, as you say, is what's needed. And as you quite rightly say, every global reserve currency started off being backed by gold. And you also made the point about perception, right? And arguably, the United States' perception on the world stage has been damaged by the Biden administration. Many people consider the withdrawal from Afghanistan as a pivotal moment in terms of signaling weakness, lack of appetite for standing ground, and the thing that was potentially keeping the US dollar and faith in the US dollar strong was this perception of US military might. And also the fact after 1971, when Nixon took us off the gold standard, there was the deal to put us on the petrodollar, or make the deal that that oil will be denominated in dollars, and we had the petrodollar. Now we're sensing a tremendous shift, and I want to bring it back to the alternative of the BRICS, right? Because there was talk, as we know, earlier this year, and in several gold conferences, that the BRICS, Brazil, Russia, India, China, and South Africa, wanted to de-dollarize. They made that very clear, and that there was some speculation that they would launch some kind of commodity-backed, potentially gold-backed common currency. That didn't happen in the most recent meeting in South Africa. They continue to encourage trading amongst their own currencies. We are also seeing that central banks around the world continue to increase their purchases of gold. To your point, World Gold Council saying that 2023 looking to overtake 2022 in terms of record purchases of gold. But when we say go back to gold, would that not require some other country, some other currency to make the first move, to come out and say, forget the dollar, it's backed by nothing, but BRICS common currency or new version of the yuan 2.0 or whatever it is now backed by gold? Would that not be the first step needed before this collapse that you're talking about happens?
Well, first of all, your points about Biden, sure. I mean, Biden did quite a bit to accelerate the dollar's demise, but it's long overdue. I mean, it should have already happened. But yes, I mean, running up the already large deficits, the spending bills that the Biden administration signed on to made it worse. Certainly, the sanctions imposed on Russia highlighted the need to de-dollarize, and so he's brought it forward. He's made some bad moves as president. But as far as what's needed for a gold standard to reemerge, I think it's mainly going to come from the public. It's not going to be the government saying we're going back to a gold standard. I mean, that's the last thing they want. It takes away a lot of their power. It's just going to be a refusal by the public to accept these currencies, because as they really start losing value, particularly the dollar, the market will look for alternatives. And it's ultimately, if you are a seller, a provider of services, or a seller of goods, you decide what you want to be paid. And if I'm not going to be paid in a form of money that I'm willing to accept, then I'm not going to sell. And so you're going to see more and more people not wanting the dollar. And then what are they going to accept as an alternative? And I think gold is something that will be an alternative. And it's really easy to remonetize gold today, because you have the internet, and you have blockchain and all kinds of interesting innovations that would enable gold to circulate globally as a medium of exchange far more efficiently than it has in the past. And it worked great in the past. It could work even better now. And some countries, it may be that some governments could see the writing on the wall, and they want to position their currencies to be more readily used in commerce, not necessarily to supplant the dollar, but just to have a larger role. And they may decide to back their currencies by gold. They may decide to do a national digital currency that's backed by gold. I mean, all this can be done. I mean, why do you think all these central banks are buying gold? I mean, they're not, it's not an accident.
It's not a trend we can ignore. Absolutely not.
And because they need real assets on their balance sheets. They just can't have somebody else's liability. They have to have real money behind their currency. And a lot of people will say, well, but there's not enough gold to make the monetary system work. Not at $2,000 an ounce. but it may work fine at 20,000 or 30,000. It's just a question of where do you reprice gold in order to make the monetary system work. Now, it worked in the past when gold was $35 an ounce, but that's because we hadn't printed all this money, right? So prices were a lot lower. Money supplies were a lot lower. But in today's world, if you want to bring back monetary order and return to a sound monetary system anchored in gold, you can do it, just not at $2,000 gold. It's going to be a much, much higher gold price, which is why I recommend that people buy their gold now before it gets repriced 10 times, 20 times higher than at the current price.
But my main takeaway from what you said there, Peter, which is not what I've heard other people say, is that you see it coming from an individual level, from private citizens, from the private sector. You don't see some watershed moment where, as I say, some other nation launches a gold-backed currency, or a group of nations launch.
There could be other nations that do it too, but again, it's because they perceive that that's what the people want. I mean, money is a product, right? I mean, the governments are creating this product, but the people have to want to use it. Now, you can have laws, legal tender laws, and try to force people. But, a lot of these countries that have lousy currencies, what happens? They have black markets, they have underground economies where if you actually want to buy something, you need, hard currency. They don't take the local currency. Maybe they take the dollar. Maybe they take the euro. They don't want whatever peso there is. And so it's the market is trying to, adapt to what governments are doing. Just like, the government run the post office. And so people didn't like the post office. And so Federal Express comes around and more people, I'll use FedEx because they're more reliable. So if people start to look for something more reliable than the dollar, when the dollar is losing purchasing power slowly, maybe it's losing 2, 3, 4, 5% a year, all right, you can deal with it. When it starts to lose 5% a month, it becomes very problematic. And so people will start looking for alternatives. Governments will start looking for alternatives.
But what would be the tipping point, right? I get the slowly, then suddenly. But what would be the tipping point that there's enough momentum of enough people across the globe sort of saying, we don't want the dollar, we're going to gold?
Again, I don't know what number. It's obviously a confidence game, right? I mean, enough people have to lose confidence in the dollar and then the game is over. Because what gives the dollar value? It's just that confidence, right? Because there's nothing real there. There's nothing tangible there. And so what is the critical mass that it takes to precipitate a run? I don't know. I mean, I know it's there, right? It's like the question, how many straws will break the camel's back? Well, you don't know until you put the last straw on there, right? And he buckles. So I don't know. But given where the numbers are, I think we're going to find out pretty soon. The thing is, you want to find out prepared. You want to find out when the dollar breaks when you've already sold yours. You've got to accumulate other assets. You don't want to find out after the fact because then you're broke and it's too late to do anything about it.
When you say what backs the dollar, full faith of the US government, and we talked about Bretton Woods, and the dollar became the global reserve currency after the US basically helped the Allies win World War II.
But the full faith of the U.S. to do what? Print money? I mean, that's all. I mean, they don't. There's no real promise to give you anything.
I'm talking about potential military might here, right? Because I'm going back to World War II, and the U.S. helped the Allies win World War II, and then we had Bretton Woods, and then the U.S. was the top standing economy and had the biggest military, and so it all went back to the U.S.
Well,
and some have argued that potentially a way to stop this, and this may be a bit conspiracy theory, but some have argued that a potential way to reset this, to start this, would require a major global conflict where the U.S. has to once again reassert military dominance. Whether the U.S. has that capacity or not is another conversation.
Well, it doesn't have the capacity.
In terms of military dominance, but is that a theory that you think is plausible? Is that something that could potentially derail this devaluation? Because,
I don't think so. First of all, the reason we were able to help the Allies win the Second World War was because of our industrial might. I mean, we were the arsenal of democracy, or we had all the factories in America. We built everything here. And so in order to win a war, you needed, tanks, and you needed planes, you needed ships, and we built all that stuff. And that's what, enabled us to prevail in that war. America today doesn't have all that industry. We actually have to borrow money to finance our military. And we're not going to be able to do that. So, at one point in time, the Soviet Union was a giant military power, right? We had the Cold War, we had the U.S., and we had the Soviet bloc. And they collapsed because they were broke, and they could no longer afford the military anymore, right? And so they collapsed. I mean, I think America is in a similar position where we can't afford our military. We're paying for it with borrowed money. We pay the soldiers in borrowed money. If the dollar collapses, I mean, the soldiers aren't going to work. I mean, they're going to have to go home and get some other job if the U.S. government only has dollars to pay. How do we provision everybody? How do we supply everybody? Where do we get if the dollar crashes, it just takes down our military might with it. Plus, it's not like if countries start abandoning the dollar, we're just going to invade them and say, well, you better take these dollars or, we're going to nuke you. I mean, I don't know what good our military is in a situation where people around the world just don't want to buy our bonds anymore. I mean, how do we declare war on somebody because they don't want to loan us money?
I hear your point, but by way of the conspiracy theory, and I acknowledge conspiracy theory, it doesn't work like you're not buying our dollars, we're taking you to war. There are other circumstances that allow for the U.S. to flex its military might before the dollar crashes, before the U.S. soldiers say we're not getting paid, we're not showing up. And at the moment, the U.S. still has the largest military. Just putting it out there as a theory. And again, I'm certainly not advocating for war.
If the U.S. can do that and it causes the dollar to rise off some flight to quality, we can get away with it. But if they're doing this in an environment where people are trying to get rid of the dollar and big deficits and inflation are a big factor that's motivating the desire to get out of the dollar, if we have a war, that just means bigger deficits. That just means more money printing, more inflation. And we now made the dollar even less desirable because we're at war than it was when we were at peace. So it's going to backfire if they try that. When the dollar was regarded as the safe haven and everybody wanted it, yeah, that worked, right? Go to war and create demand for dollars. It's also interesting if you look at the fact that the world is at war right now. I mean, the U.S. is not involved directly, but there's war in the Ukraine. There's now war in the Middle East. And the dollar's not really going up. And even all these rate hikes by the Fed haven't lifted the dollar. They lifted it off the lows, but it's been pretty steady here for about the last year. And I think, as I said earlier, it's getting ready to crack. And once the dollar starts to fall, it's got a long way to drop.
Again, that's just a devil's advocate response because that is something that's sort of, potentially gaining some kind of alternative attention. Is there anything, though, then, short of a war, which you don't think would do this anyway, is there anything that derails the scenario? Is there any...
You mean my scenario?
Your scenario. Is there anything that can happen that changes everything?
Well, I mean, nothing that is likely to happen will change it. But clearly, a lot has already happened that has delayed it. So am I going to say that it's impossible to continue to delay the day of reckoning and kick the can down the road? No, it's not impossible because we've already been doing it for a long time. But the longer we do it, the harder it is to do because that can we're kicking is getting heavier and heavier and heavier if you look at the numbers, look at the debt, look at the predicament that we're in. And we get to a point where you can't do it anymore. And I do think we are very, very close to that point. Could I be shocked that we've pulled some kind of crazy rabbit out of a hat somewhere and maybe we can push this off for another 3 or 4 years or 5 years? Maybe. But if we succeed in doing that, we just make it even worse. Not that it's not going to be horrific if it happens now, but it's going to be even worse if it happens later. The sooner, the better. As far as, it's like if you're in a hole, I mean, you got to stop digging the hole. We have to get out of it eventually, but the longer we keep digging it, the harder it is to get out of it because we're in an even deeper hole. I mean, we're already in the Grand Canyon of holes. So it's like, digging this thing any deeper, it's just going to end up being a grave because there's going to be no way to get out of it.
Well, look, throughout history, mankind has debased every single global reserve currency, every single reserve currency. I always like to point out that there was a time when the Portuguese escudo was the world's reserve currency. So we see this pattern. Every reserve currency has a timeline. But Rick Rule, who's a regular on our show, likes to say, what is inevitable is not necessarily imminent. So how long is is this road? You know, because
again, I don't know how long the road is. I just know that eventually you run out of it. And I know where you're going to end up when you run out of road. I don't want to be there financially. I mean, I may be stuck there, you know, physically. But I know how the game ends. It's not going to end well for the dollar. It's not going to end well for dollar-based investments. And so I'm just going to position myself that way. Now, as far as how does it end for Americans, you know, it's a tough call because, you know, could this crisis be a catalyst to making the types of reforms that we've been delaying making for, you know, a couple of generations here, as far as reigning in government and going back to the principles that built the republic of limited government and sound money? I mean, is this going to be a catalyst, you know, to go back to, you know, and embrace those values, which can ultimately be very good for America in the long run? But is it going to be a catalyst for America to abandon what's left of capitalism and just fully embrace socialism? And in which case it's going to, you know, be an unmitigated disaster. But, you know, I don't know that history has been written yet. But it is very dangerous when you look at the political winds and how they blow, and you look at, you know, how dumbed down the American electorate has become over, you know, the generations of government schools. I mean, we have a very ignorant population. Not everybody, but the masses. Yeah. And when everybody gets a vote, right, the idiots get to outvote the people that have an understanding. It's very hard to outvote the idiots when they outnumber you. You know, so that's the inherent flaw in democracy.
We used to say that people were uneducated or not smart because they didn't have access to information. Now we have all the access to information you may want in the form of the internet and cell phones. And as they say, smartphones are only making us dumber.
And some of it is we've raised now a population of people who feel entitled to stuff, that they don't have to work. And that they can just get stuff for free. They can just get stuff from the government. And they don't realize the government doesn't have anything. All the government has is what it takes. And so you have a nation of people who want the government to steal from other people and give it to them. And so once that mentality, you know, really permeates the majority of the population, you know, you're really doomed. You know, and so, you know, that's a scary position to be in. But, you know, who knows? I mean, again, we do have the internet. We do have a way to get out information. I mean, maybe people could, you know, be made to understand, or maybe a critical mass. I mean, fortunately, not everybody goes out and votes. A lot of people stay home, which is good, because then maybe the people who go to the votes can do the right thing.
We'll get to the vote and a point you made in your speech last night that I want to reference. But you said Doom, and that reminded me of Dr. Doom, Nouriel Roubini.
Well, that was me. Well, I was Dr. Doom. I was Dr. Doom before he was Dr. Doom. The New York Times started calling him Dr. Doom after the financial crisis. But CNBC was calling me Dr. Doom for 3 years before the crisis because I was predicting it. But then once it happened, the New York Times didn't really want to give me any credit. So they gave the credit to Roubini instead.
Well, I will let you two duke out that Dr. Doom title, but he was also one of the few that was warning about the financial crisis of 2008 and was talking about the subprime mortgage collapse. And I bring him up because he has made some interesting comments about this current geopolitical situation that we're in, which again, I think, as we've just discussed, can go in many different directions. And he has said that the baseline view of the markets, as it's been reflected right now, is that the conflict is confined to Israel and Gaza. But there is a risk scenario, a tail risk scenario, that Iran unleashes Hezbollah to prevent Israel from destroying Hamas. And we heard from Hezbollah's leader just today, not saying the kindest of words about Israel or the U.S. as expected. Roubini says then Israel, U.S. attack Iran. That's also going nuclear. Then China blockades Taiwan as U.S. bogged down in two wars, Russia, Ukraine, and the Middle East, and World War III. Again, he says it's a tail risk scenario.
I guess World War III is always the worst case scenario.
But what are your thoughts on this potential, and why, even if it is a potential, is it not being reflected not in gold so much and not anywhere else in the market?
There are a lot of things that are not being reflected in gold. There are a lot of risks that for now, the markets are ignoring. That's just one of them. Yeah, I mean, it's a potential powder keg there. It's terrible what's happening. I feel horrible about it. I don't see a easy resolution. I think it's going to get worse. And could more nations be dragged into it? Could this war expand in the Middle East? Yes. Is that going to be a problem? It will. I don't think it's going to result in money flowing to the dollar like it might have in the past. I think it's going to exacerbate our problems and maybe hasten the crisis that I'm expecting. But that's just one of the many problems that people have been ignoring. And if you look at the stock market, I mean, the U.S. stock market is at record levels as far as valuation. Even though interest rates have risen, even though corporate earnings are now in jeopardy, not just because corporations have a lot of debt they now have to service, but their revenue is going to be going down. And governments, it's not just the federal government, it's all these state governments, municipalities, everybody was borrowing money. And now the bills are coming due, the rates are going up, everybody's getting squeezed. So, there's tremendous amounts of risks. At some point, they're going to blow up. And let's
hope this particular scenario doesn't blow up for, of course, the sake of civilization at large. But assuming that things stay confined in the Middle East and all the other factors that we've discussed are still at play, what is your gold forecast then for 2024, end of 2024?
I just, I don't know.
Because you're ready to call a bottom at 2,000.
Well, a bottom is a lot harder to call than the top because we're a long way from there. Look, I think gold prices are going much, much higher. I remember back in 2010 or 11 or 12, I was talking about $5,000 gold, and a lot of people teased me, oh, it never got there. And no, it didn't, but now that we've spent the last, dozen years, on a print fest and all the extra debt and all the mistakes that we've made and the fact that we've succeeded in kicking the can down the road, gold's not just going to 5,000. I mean, it will, but it's going much, much higher than that. How much higher, I don't know. I mean, there's technically no ceiling on the price of gold because there's no real floor to the dollar. I mean, gold can go to infinity if the dollar goes to zero. But I do think that the gold price, once it starts to move, it's going to move up dramatically and rapidly. Whether that process starts in 2024, it's hard to say. But you want to own gold. You want to own silver. You want to own the mining companies that have the gold and silver. The upside, I believe, is just phenomenal. I mean, people made a lot of money in these stocks in the 70s. I think they're going to make more money this time around. And the 70s, the 70s was a big change from the decades that preceded. I mean, people made a lot of money in the stock market in the 50s and the 60s, the go-go 60s. But in 1966, the Dow was worth 20 ounces of gold. By 1980, it was almost 1. It was a record low. It was actually lower than it was at the bottom of the crash in 1932. People lost back decades worth of stock market gains during the 1970s because they stayed with the stocks that worked in the 60s and they didn't understand what changed. The people who made money in the 70s were the people who bought gold or gold stocks. You couldn't even buy gold. It was illegal in America, but you could buy the stocks. People bought oil. Oil went up 10 times. But people also made money who invested in Japan, invested in Germany, right? These were the countries that lost the Second World War. You invested in them and you made money in the 70s, but the people that stayed with U.S. assets got decimated by inflation. And I think this time it's going to be an even bigger a round of inflation than we had. And people forget one of the ways that we kind of survived the 70s was married women didn't work in the 40s, the 50s, or 60s. I mean, their husbands supported them. But their husbands' wages lost so much value during the 70s that all these married women had to start working. But today, you don't have, a spare worker like sitting, at home. They're all working. In fact, now people have 2 and 3 jobs apiece. So what are we going to do? Right? Are we going to pull kids out of school and send them to work? Because how are families going to survive now? This decline in the value of the dollar, which I think is going to be worse, a bigger drop than what we had in the 1970s.
So what is the best way then to protect one's portfolio? And I get it, it's different depending on people's individual circumstances, but overall, what is the strategy that you're looking at?
Well, my strategy has been consistent for years now, and I've been early, granted, but I'd rather be early than late. Even a day late is, you're too late. But I invest in quality, dividend-paying stocks that I think are going to maintain their earnings and their dividends, in fact, grow their earnings and their dividends, even in an inflationary environment where consumers are cutting back, because the businesses that I own are providing services and selling goods that people need, right? Not things that you want, and if you have any money left over after you pay for your needs, then you buy some of these things. You want to have companies with pricing power that are going to be able to stay ahead of inflation. You want to have income coming from outside the U.S. if I think the dollar is going to be hit particularly hard. And you want to own real things. You don't want to own a bunch of paper. You don't want to be a creditor. You want to own commodities, resources, the metals, energy, agriculture, companies that own these resources, that harvest them or mine them. And so I have portfolios that would have done extremely well in the 70s, and I think will do even better now at protecting people from this, dollar devaluation, inflation tax, however you want to define it. So people can, people can use my funds. I have 5 mutual funds that we manage, and the portfolios are very unique, designed to thrive in these environments. There's a Euro-Pacific Gold Fund that you spoke with Adrian Day. He manages that for me. I got an international value fund, a international dividend pair fund, an emerging market fund, a foreign bond fund. You can look at the Euro-Pacific funds, any of these discount brokers. They're all available, no load. If you want to contact my representatives at Euro-Pacific Asset Management, you go to europac.com. We manage custom portfolios of individual stocks around the world that are really designed to stay ahead of inflation and provide reliable sources of income, so that when the dollar collapses and prices go way up, that you now have assets that will appreciate and income that will rise faster than your cost of living, so you can stay ahead of inflation.
How have your funds performed in this environment, though? I get that this is a future protection of strategy.
Give you an example. So they did fantastic last year in 2022. I mean, we had funds that were up when everybody else was down. I mean, I got an award. My dividend pair fund was the #1 international fund out of like 350 funds. Lipper, Morningstar, I got all kinds of awards for that one. My bond fund, at one point, I had the #1 bond fund of the year. I think I still might finish the year at #1, but I think now I'm only in the top like 7%. But I think that by the end of the year, my bond fund could be #1 for 1 year, 3 year, and 5 years. So performance has picked up over a longer term, like a 5 to 10 year. The strategy has lagged behind because we haven't had the tech stocks or these financials. But if you look at what happened in 2022 as kind of like a test run, when stuff started to go down, that's when we really did well. But the dollar didn't even go down that year, because my portfolios are designed for a weak dollar. And we've still delivered, returns with a strong dollar. But where they really thrive is when the dollar starts to go down. And when you see a bigger shift from the U.S. to international and from developed to emerging markets, when those trends really take hold in a bigger way, that's when you're going to see, I think, tremendous outperformance of my funds, not just relative to their peers, which, and I have been outperforming the peers, but relative to the U.S., because I think the U.S. has a long way to fall in relation to the international markets. If you look at like the value of U.S. stocks relative to the rest of the world, it is very heavily skewed. U.S. stocks are extremely overpriced, and there's a long way for them to fall.
I want to wrap up with something that you said last night. I said we'd come back to Biden, because you mentioned Biden and former President Trump as well, current President Biden, former President Trump, in your speech last night. And you're certainly not one to shy away from making bold predictions, because unless I misheard you, you said that you think President Trump will win the next election, because you said that the economy is, people are frustrated with President Biden. Again, there are a number of reasons for that, but you're saying that the economic situation is being reflected in Biden's lack of popularity. I would argue that's one factor amongst others. But you made the bold prediction that you think President Trump is going to win in 2024.
Well, that's not that bold. I mean, he's obviously going to get the Republican nomination. I mean, there's nobody that's even close to him. And I don't see how Biden can win. I think as unpopular as he is now, he's going to be even more unpopular a year from now when the elections are coming around. We could easily be in a declared recession by then. I think prices will be much higher, consumer prices, so the economy is going to be worse. Who knows, these wars could be worse. I don't know what that could happen to improve the situation between now and then. And people tend to vote their pocketbooks, and I think the Republicans are going to have a strong message that everything was great when Trump was president. Not that I believe that. I mean, the Republicans say we had the greatest economy in the history of the world when Trump was president. And that's not true, but the voters don't know that. The voters are going to know how much worse they are now, right? It's like, it's the economy stupid. Reagan beat Carter, with the misery index. Mm-hmm. And, Carter's a good kind of comparison to Biden administration. You have to go back to Jimmy Carter to find a president as unpopular as Biden, and he didn't win, right? He didn't get a second term. He had one term. So now maybe Biden will step down. Maybe they'll have somebody else run. That person may have a better shot than Biden, but again, the electorate tends to throw the bums out. Whoever's in power, gets the blame, and if things are as bad as I think they will be, I don't think that people are going to vote for 4 more years of that. They'll give Trump another shot. Now, if Trump wasn't the nominee, if there was another Republican, then that person would win. Okay. I just think I just can't see unless there's widespread fraud. So
that's a whole other conspiracy theory, Peter, that I guess many of our viewers would argue is a big factor to consider as well, assuming that everything is running as it should and that we can trust the institutions. But again, I thought it was interesting that you made that bold declaration, and that you're saying.
Well, I predicted, I thought Trump was going to win the first time, and I thought he wasn't going to win the second time. So I've been pretty good at handicapping whether I thought Trump was going to win or lose.
Okay, and that's even, you think, if, say potentially Gavin Newsom jumps in the race, or some chat that Michelle Obama could come in. There's a lot of, speculation that Biden may be replaced by another.
The Democrats might do something when it's so obvious that their guy is going down. They're going to have some graceful way to get him off the ticket, right, and replace him with somebody else. And they'll probably have all kinds of, study groups, and they'll poll it all and try to figure out who's, what scenario works. But it may just be, rearranging the deck chairs on the Titanic. I mean, the administration, the Democratic administration, is going to sink. But it doesn't mean that it's going to be a panacea to just put Trump back in there, because, what did Trump do as president? He ran up the deficits. He spent money. He can't keep doing that like he did before, because if we're in a debt crisis, more debt isn't the solution. We have to actually cut spending, which is something that Trump didn't do. He did cut some regulations, which was good. We just need to cut a lot more. But we have to really cut spending. And, a lot of stuff he's put off the table. Entitlements. Trump doesn't want to cut Social Security or Medicare. Those things need to be cut. I mean, we're not going to solve these problems unless we make those cuts.
So if I may condense your points here, assuming elections are free and fair and reliable, you think Trump wins in 2024. Mm-hmm. But either way, you think the dollar's days are tremendously numbered, and you see gold going to at least 5,000 and the dollar
probably
losing
much higher.
And the dollar losing its
regardless of who's president. But it would be nicer to have Trump in there, because I think that the odds of us ultimately doing the right thing after the crisis, nobody is going to do the right thing before the crisis. No politician is going to do anything to prevent the crisis, because that requires bad things happening sooner. And everybody has a political, impetus to just kick the can, right? I don't care if the pain is worse. If it's later, that's better. So we're not going to defuse the bomb. It's going to go off. But in the aftermath, having Trump as president will be much better than having Biden. So it's not about avoiding the collapse. It's about cleaning up the mess and about doing the right thing and the aftermath. And the odds are greater with Trump.
So Peter Schiff says, Trump likely to win 2024. Either way, dollar's days are numbered, the dollar is doomed, and gold is still set to outshine and outperform everything else.
In the short run, yeah. But the dollar could always be resurrected if we do the right thing eventually.
I think that's the most hopeful thing I've ever heard you say. The dollar can still be resurrected. All right.
Yeah, I mean, it's going to be tough.
Okay, that kind of changes things. We'll have to revisit that whole scenario some other time because we're out of time now. But thank you so much for sharing all your insights with me and with the Kitco viewers. We really love having you on. Thank you, Peter.
All right, my pleasure.
All right, and thank you for watching. I'm Michelle Makori. Stay tuned to Kitco News for our ongoing coverage from the New Orleans Investment Conference.
Kitco News special coverage of the New Orleans Investment Conference is brought to you by Discovery Group.